Welcome to Multiple Perspectives. I'm David Lofgren. It feels like the commercial real estate market is at a pivotal moment right now. Investment strategies are evolving based on this sort of post-pandemic inflationary period where technological advancements and shifting economic conditions are just starting to actually be reflected in the behavior of market participants. At moments like this, it can be really helpful to zoom in a bit, to abandon the 10,000-foot view, and to talk with folks who are actually playing in the field, the individuals who are transacting in the midst of these shifting conditions, to get a sense of how their particular submarket or asset class niche is responding to these changes. Today, I'm joined by someone who has been having exactly these types of conversations. Equity Multiple's Senior Director of Investor Relations, Daniel Brereton. Daniel, welcome to Multiple Perspectives.
Thank you, David. Really great to be on.
So you're here today because you just finished taping an interview with someone who can give us this sort of boots on the ground perspective on his particular slice of the CRE market. Do you want to tell me who the conversation is with and what we're about to hear?
Sure. I like to talk to all sorts of sponsors, and we like to talk about their types of deals. But I think with this one, I was speaking with Brian Ker, who's president, CEO, founder of Snowball Developments, who they're a local sponsor here in the Northeast, in the tri-state area in New York. And we've done several investments with them at Equity Multiple. But in this conversation, it's not just about a deal. We're really trying to get under the hood and understand how he started his firm, how he started in real estate, and what his journey was like, the skills and knowledge that he gained along his career path, and I think the unique way that he sees the market, which I always like crosscuts on the knowledge. Everyone can have a consensus opinion, but it's really cool to hear from someone who's got a different view on the markets, who really wants to do the work. And Brian, he's an all-around great guy, I think, and he really sees doing real estate as a force for good, which is very, very unique, I think, in a lot of ways.
Awesome. Well, I can't wait to hear the conversation. In fact, that's probably enough of an intro. Daniel, why don't you take it away?
Thanks, David. Brian, welcome to Multiple Perspectives. Good to see you again. This is the second time that we've been speaking. How have you been?
Doing great. Thanks for having me on.
Yeah, of course. You've had a really interesting journey, career transitions. You started at CBRE up in Canada, working on commercial real estate. And, then your journey took you to starting Snowball. What drew you to focusing on industrial specifically, though?
Industrial real estate is something that I'd always been involved in up in Montreal, Canada. And it's really an interesting land use case story of, towns, particularly harborfront towns, being centers of industrial commerce, transitioning from industrial commerce to distribution, and then ultimately being big population basins that now industrial businesses and that previously required labor are now converting themselves into distribution and distributing to those large affluent population basins. So it's a really interesting case study of international commerce. It's an interesting case study of how people consume products today. And, from my perspective, you want to be a part of something that's exciting and dynamic, and ultimately where there's greater demand than the ability to supply said real estate.
Yeah. I like the tri-state area that you focus on, especially, has a lot of intersections. It's where a lot of world commerce goes down. And what we've seen is industrial assets, and particularly, have been really high growth. They've been very resilient across cycles. What current trends in the market and operational trends that you see might define the next 5 years for this type of asset class?
I think it's a continued growth of vertical real estate in the New York City area. And we've started to see some transactions now provide comfort to those who were the pioneers in that space. And this isn't necessarily new as an overall theme. Japan, Hong Kong, Singapore, other very dense places have had vertical warehouses or vertical factories for a long time. But it's starting to come down in New York City. And what that means is that now that the pioneers' business plans have been supported, we're going to see additional developers enter with additional capital to try and figure out the most intense form of vertical distribution within the New York City metropolis. And whether that's going to be in Brooklyn or Queens, Staten Island, potentially the Meadowlands or the Bronx, getting product to the population that wants to consume it is going to be a challenge. Just today or yesterday was the start of congestion pricing, an extra consideration for trucking and transportation to come into Manhattan. And ultimately, you kind of want to be where all the action is and where all the excitement is. And, we could be seeing drone delivery and other sorts of transportation to get product around. I think rules and regulations combined with natural geography and its challenges and opportunities creates for an exciting landscape. And that's where we want to play.
Yeah, it's funny you mentioned that the congestion prices, because it really does reshape how different transit comes in, how different shipping happens in the city, and how people are moving around in different areas. But I think specifically for you as a more nimble firm, what other differentiators do you think that you and Snowball have that could potentially capitalize on some of these trends and these changes that are being forced on the market?
Well, you skipped a stop in my story, which is that between being at CBRE and being an investment sales broker, I went to go work for the New York City Economic Development Corporation when I first came to New York City. And part of that was to really deeply understand New York, understand the political forces, understand the natural challenges, that come from being a city of 5 boroughs and spread between a series of waterways and bridges and tunnels that separate people. Some of the racial and demographic challenges that New York City has that are quite different than what I would have experienced being in different port cities, like where I grew up in Vancouver or where I did most of my early business career in Montreal. So to me, it was an opportunity to get to know New York City and as an outsider, to make relationships, which is so important in this business, to understand what it means to be a government stakeholder and a public servant, so that when you sit down and you have those land use conversations, you have a good understanding as to what the other side is solving for, because it may not be what you're solving for. And so, that was a great opportunity, because when you work for the New York Economic Development Corporation, you have to understand what it stands behind. It's looking for economic development. It's looking for social policies and social programs to be funded by developers. There needs to be a public ask, and you need to find a way to fulfill that. You also need to put together a development team that also meets some of its social goals and ambitions. So you can't just, I'm a white male. You're not going to get around the fact that you are who you are. So why not zoom in and figure out what you need to do to be successful in New York City? So we're nimble today and operating outside of New York City, partly because of when I started the company, I was conflicted, and partly because I felt that the perimeter around New York City was benefiting from some of the policies that New York City was imposing on businesses and its people. And that was where I felt the greater growth story would be. Long term, it could be that New York City becomes our favorite, investment arena.
Yeah, and the tri-state is the broader metro that a lot of people talk about. There's a lot of commerce that comes through industrial facilities in Connecticut, like you invest in, and northern New Jersey. But even within that tri-state, it's a fairly diverse area. And obviously, you've got direct experience working in New York City with the development committee. But what about the rest of the tri-state, and broadening out beyond just core Manhattan real estate or core Long Island real estate or anything there? What about the diversification benefits of the rest of the tri-state, and how does that interplay, especially having to, even though it's a connected area, having different types of regulations and different types of markets that develop even in such a small area?
Yeah, well, the tri-state is fueled by what happens in New York City. Anyone who thinks otherwise, and I see a lot of politicians who think that New Jersey would just be a standalone state as prosperous as it is. New York City didn't exist, and they're lying to themselves. The same can be said for Southern Connecticut and other parts of Connecticut. It's a strong, resilient urban fabric where the tri-state, supports a more suburban, sometimes more rural or exurban, lifestyle. But ultimately, the transportation network fuels people coming into New York City, where they're able to earn income levels that are unachievable anywhere else in the North America, continent. So that's what drives, the tri-state. What we've been trying to identify through our investment thesis is to identify established business parks for companies that serve the regional economy, that service into New York City as well, where those business parks are full. There is no additional land truly available for development. If there is additional land available for development, it's far more expensive to produce a building than what is available to lease or where lease rates are, currently today. And in our view, a rising tide lifts all boats. And so we are also looking for those submarkets where rents have the greatest multiple effect of growth over a short period of time. So starting from a very high rent place, like the peak rents that are out in the New York City region are in Queens. Maspeth is a submarket, or Bronx around Hunts Point, which is the food market, or maybe South Brooklyn, where we're now starting to see this vertical multi-story industrial development, $30 to $35 rents. So the question you ask yourself, are $35 rents going to become $70 rents, which is a 2x multiple in a short period of time? Or will a $4 rent become an $8 rent in a short period of time? Now, intuitively, I think most people would say 4 to 8 versus 35 to 70. And time will tell if we're right or wrong. But I think that we're more likely to be right than wrong.
Yeah, it's an interesting way of looking at the world. And you mentioned, not a lot of competition from new development. And I think what you might see in the parlance of real estate, right, that we talk about these infill areas, these areas where you can't build more stuff on top, where you can't have the competition. It's not Texas where you can just keep building out and sprawling out. These are very tight areas with a lot of density when it comes to the real estate and the people and the commerce and transactions, and rising tide, but also almost like a pressure cooker, keeping the activity going. Right.
Right. Well, they're dense urban environments because a lot of people want to live there, and then there are also geographic aspects of wetlands, of estuary regions, of reservoirs, that are all littered throughout the tri-state. I mean, we are at the confluence of 5 major rivers that all come into New York Harbor. And all those waterways produce floodable areas that we're not naturally allowing people. This is in Florida. You can't just build another subdevelopment in an area that's going to flood or be hurricane prone. So call it what it is. The regulations of land use force density into the areas where it's acceptable to build more housing, to build more office or hotels or retail. And then industrial is a service component to all of those, elements. So, those urban infill industrial business parks that we're targeting, where we feel that the rent growth potential is very strong, is absolutely that. It's because, we think that there's going to be additional rooftops, whether it's vertically produced or horizontally produced, and a rising demographics of people that are going to live in those areas that is going to support more demand for industrial product, where it is challenging to build new industrial product. So yes, it's the pressure cooker, and it's land use, and it's dynamic, and all those things we enjoy.
Yeah. It's interesting that you mentioned about the wetlands, environmental issues, things that are forcing the hand when it comes to development. And you're right, people do continue to move to areas like New York and Los Angeles and Miami. Now, the latter of those two, LA and broadly California, and Miami and broadly Florida, they're affected by some climate changes as well, which we saw some of it here in New York. There are some wildfires north of us in upstate, and it's frigid cold today. So with a lot of
not
wind,
cold for a Canadian, but sure.
No, not sub-zero and on either scale. But it is a dynamic period, not just for real estate, but for the weather and the climate as well. How are you thinking about that? Because Florida and California, there are some uninsurable areas, and I don't think that New York has gotten there yet, but there are some changes. How do you think about these types of risks outside of just the financial risks, the understandable risks, when you're putting together a portfolio, when you're putting together a deal?
I mean, we are betting on the long game that climate change is actually a force for good for the Great Lakes, tri-state, Northeast region. I mean, absolutely, it's front of mind. We are avoiding areas that are hot today because people want to go there, but they can't support possibly a population long term. I mean, I think about the fact that if, sea levels rise X feet, how many residential buildings are uninhabitable and what that would potentially mean to the industrial demand, right?
Yeah, it's a lot of calculus, and you're right. These are not low
Because what
low elevation areas.
what we're looking for is persistent, strong industrial demand, not hot, demand in a moment in time, but persistent demand. Because only through persistent demand are you going to achieve consistent rent growth, and consistent rent growth, and not, volatile rent growth, both positive and negative, is what investors need for confidence. It's what is going to drive cap rates and yields, down, because you're able to make up for those, lower initial yields through future rent growth and consistent, persistent rent growth. So to me, it's a mathematical exercise of where is the least risky place to invest. And some people hate taxes, and some people hate regulations, and some people will, be fervently anti-blue state. But blue states and regulation create a more predictable real estate environment, as much as it perhaps may be less dynamic. So we've tried to pick what we think is the most dynamic real estate asset class in possibly the least dynamic land use areas. And that's a good bet in my mind.
Yeah, I like the way that you describe that with you like stable and consistent areas with growth potential, that you're finding value opportunities in those stable areas. So you're finding these diamonds in a great area that you're able to take advantage of those opportunities and get the rising tide along with it.
Correct. And when people talk about asset selection, deal selection, to us it's, and again, I was an investment sales broker, so I've run many processes along the way, both of sophisticated and less sophisticated clients or owners who really know what they own versus those who, not for their, lack of skill, they just may not be a real estate person per se. And when they put it on they put that product on the market, they're surprises, and those surprises are typically negative to value. So, our ability to focus on a specific geography allows us to hopefully spot the opportunity where someone has, I wouldn't say the word mismanaged, they just haven't optimized, their ability to generate the maximum income at the property. And coming in with our experience and with our deal partners, we're able to see where those opportunities can be and move, those business plans into play. So you're talking about, you're right, there's some aspects of the geography, there's aspects of the region that are all good, but then you also, because it's an older product set and perhaps not very institutional ownership of an asset class, that's where some of those, truly dynamic opportunities lie.
Gotcha. And, thinking about opportunities right now, and it's the start of the year, it's, January 7th when we're doing this recording. Tell me, there was an article in Deloitte, or that Deloitte published, about their CRE predictions. And a lot of people have been thinking about the bottom of the cycle. Have we reached that bottom? Are we about at that cusp to start coming up? How do you balance of that bottoming of the cycle versus, watching out for a falling knife, as we might call it, and taking advantage of lower prices while also keeping an eye on long-term and making sure that you have got a good asset for the long haul?
Well, I haven't read the Deloitte report, although I probably should have. And, their consensus is generally really spot on, but they obviously talk about the entire real estate market. And, we're pretty niche and pretty micro in terms of our approach. So, some of those conclusions and findings are relevant and some are less so. I will say this, capital raising is easier today than it was a year ago. There is just, I think, greater confidence to invest and to, come into our transactions. So on that standpoint, it does definitely feels like we're off the bottom of a capital aspect of the cycle. But that said, I mean, I know that investors are still, finding that, navigating this climate is tricky, and that there are, still going to be foreclosures, and there's still going to be situations that were certainly unplanned, and, very good real estate managers are taking losses where, they would never have expected to through their initial underwriting. From a leasing standpoint, I would say that the industrial, leasing activity is picking up, but there is still an overhang in many of the major metro markets, and that is hurting people's conviction to taking on leasing risk at this point of the cycle. So, you have to be very specific with, the type of new acquisitions that you might want to do throughout this year. We would probably want to take leasing risk that is, 12 to 18 months out, as opposed to immediate today, as a, kind of like a barometer. So, or in very specific situations, we might take on leasing risk today because the, supply demand factors are just so overwhelmingly in favor of landlords. So there's a couple elements there that I hope I touched on that, I feel like I don't think the industrial market ever hit bottom. But it may have hit bottom if you were a builder of brand new product and you just happen to be one of 35 vacant empty boxes on the New Jersey Turnpike right now. I don't think bottom has been hit yet for those people.
Yeah.
Bottom is probably when they get foreclosed on.
Well, and it's interesting to separate the two, right? That leasing bottom versus, value bottom versus, whatever else you want to look at in the market. And especially, I think for you and Snowball, that I'm picking up on is you want to be sort of not counter-cyclical, but acyclical. If you think about it, you're not trying to just pile in when things are on fire. You're trying to find assets that are neglected or potentially are not even moving with the cycle, and you pick those up, you spruce them up, you put the love and care into them that you can get, and then you can focus on leasing. So really, I guess it's a leasing risk. And can you maybe unpack that idea of leasing risk a bit when you're going into a deal?
Sure. So there's two types of leasing risk. You can either be buying an asset where there's vacancy today, or there's vacancy forthcoming, or, in another way, there's some credit risk, or you think that some of the tenants are not going to be able to pay a market rent in the future. So you'll have some level of pending vacancy risk, right? So, in each of those situations, you're doing deep market analysis around, where's your building? What is its competitive set? Is that competitive set of available properties going to expand or contract? So you have to really be focused in on what that is. Sometimes you know it, sometimes you don't. So, to a certain degree, you're also thinking about, long-term persistent demand, generators and, what that means. I'll give an example. New Jersey is the first beneficiary of the fact that New York City's real estate, industrial real estate, which is about 110 million square feet of industrial real estate in New York City, is going through its own mega boom, where rents have gone from the mid-teens to the high 20s to low 30s.
Wow.
Now, they were already really high, and they were the highest rents in the country, and now they're twice as high. So from those users, there is a certain level of, reflection on, do they want to stay in business? Do they want to relocate their business? And if they do want to relocate their business, where do they want to relocate to? Most of them choose New Jersey. And they relocate their business. They either sell or get out of their lease, and then they're able to go to the Meadowlands or go to the Port Market or go a little bit further inland and, take more space for less rent and grow their businesses that way and pay more in freight and transportation costs to service any of the New York City businesses for why they were there to begin with. But that's like what has typically fueled New Jersey's growth, a combination of national companies growing to service New York City and New York City companies relocating out of New York City because their site is a perfect condo site or a residential development site. And, then, deciding that they, should come to New Jersey and run their business. So you're always looking for, what is going to be that persistent, demand that's going to fuel, the growth in that market. So when you're thinking about vacancy, it's like, where is that vacancy going to come from? Are you going to be taking your next door neighbor's tenant, or is it going to be a new market entrant that's coming in, right? And so we think about that a lot when we're thinking about, both in-place vacancy, potential vacancy because we know a tenant is leaving, or potentially a tenant that's not going to be able to pay the market rent. They like to be in the building, but they just can't afford to be there long term. And they might be looking for something that's just cheaper because they just don't need to pay, a market rent. And in our mind, we're trying to optimize the building so that all the building is at market rents. So that means higher quality companies that are doing more in that space and can afford because of the services they charge to their customers that they can't pay a market rent.
Yeah, I think it's also important, you mentioned about companies coming from, our businesses coming from New York into New Jersey, changes in rents, changes, especially, again, the reshuffling with congestion pricing, which is such a small thing, but it does change the calculus for everything. I think it's important to highlight on the flip side that it's not a zero-sum game, right? It's not if there's tenants not in New York, they're going to be in New Jersey or vice versa. I think that especially as more people come to New York and more people come to the tri-state area and the density increases, there's more businesses that get started and there's more tenants that can be filling these spaces. And I think that it's a broader tide that rises, not just rents, not just property values, but the economy overall, which is a reinforcing positive loop, I would say.
No, definitely. That's what we're looking for. We're looking for those submarkets and markets where there is going to be long-term demand. And long-term demand right now in industrial real estate is population growth, right? Industrial to a certain degree is retail today. And so you're looking for the number of rooftops, the number of houses, and, households. And then also the quality of those households in terms of their spending capacity. And that is what is, a big factor for industrial demand. So that's why a lot of people are going to some of the high growth markets, whether that's, in the Southeast or whether it's in Texas, understand it. But also you have this other element of developers who are building to a future demand level that may not always be there as predictably as, perhaps the models suggest. But, that's what we're looking for in our assets right now is thinking through where do we think growth is continuing to go. And one of those, analysis has brought us to Hartford. It's a market that's kind of like a two-way market. There's people that are leaving the Boston area and pushing west. There's people who are in Southern Connecticut who are being priced out of Southern Connecticut and moving north. It's a better distribution location than Albany. It serves a greater, population basis and a higher quality population basin. And it also has a manufacturing, component as well. So for us, it's one of those markets that is, top of mind right now and where the supply and demand fundamentals are so favorable that we are prepared to take on both near term as well as future leasing risk.
Very interesting. You mentioned when we were talking about, the macro picture, you said that this is a market where you've seen a lot of deals get done, where it's been pretty easy to, the capital market situation has been pretty easy, I think. That's interesting, right? Because, I know we've got several hundred billions of dollars of CRE debt coming in a maturity wall. The Fed seems to be on a potentially higher for longer stance. So, what does that look like for you? Refinancing risks, or what does the capital market situation really look like across the whole stack? Your debt financing, any pref or mezzanine that you're trying to get, and then, raising from LPs as well.
So, definitely the cost of capital for everything has gone up. When I started out Snowball bridge financing, you could get at 4%. That's now anywhere between 8.5% and 10%. And there wasn't a whole lot of differentiation, in the all-in rate. And so, certainly bridge financing is far more expensive, and that's had an impact on value for anything that's a transitional or a risky asset. But on the flip side, you just talked about the 5 and the 10 year being, well north of 4% right now. And that makes holding, assets on permanent financing also quite expensive. We're seeing anywhere between 6.5 to 7.5%, for some of our, non-class A, industrial assets. And that seems to be where it settles. So you need to be then targeting, I don't want to use too much real estate jargon here, but you're trying to stabilize your income stream at a yield that is at a premium to what your long-term financing, is expected to be. And we're not playing crystal ball in terms of where we think, the yield curve is going to go. But I will say that, we try to target somewhere around 9.5 to 10.5% as a yield on our income when the deals are fully stabilized, to give ourselves a very healthy premium over what, in long-term interest rates or mortgages, the mortgage constant would be at our properties. So that means that we need to underwrite, conservatively. And then we also need to aggressively asset manage these assets to get to a point where, cap rates move 25, 30 bips. It doesn't really change the equation too much. Our valuation is going to be, still very healthy at that point. And again, we're in the industrial, space where, rents have been relatively resilient, quite sticky for anything that's 100,000 square foot building and less. Those tenants don't have tremendous options. They can't just get a deal at one of those big distribution facilities that's been, built and sitting vacant right now today. So the 30,000 square foot tenant is living in a very different leasing environment than the 180,000 square foot tenant.
That's interesting. Yeah, across the market, it's a very different mismatch between a lot of things. And that mismatch of values and mismatch of motivations can create some value as well as some stressors for some sponsors. But I think value creation can come there with that slack, which when you're trying to take advantage of some of the displacements in the market.
Yep. No, we feel like, again, for us, it's an acquisition business first and foremost. And then we operate the hell out of the properties. The back end decision of when to refinance, when to sell, is opportunistic, really, more than anything else. So there are certain assets that we bought in 2021 that are coming up on debt maturities, and we're thinking through recapitalization strategies. We're selectively selling assets with our partners. We've sold one asset, and it ended up being a very different business plan. We sold it to a user. We found out that our main tenant, wanted to close down and relocate their operations elsewhere, put on the market for sale for lease. And the amount of user buyers that demonstrated an interest to acquire the property blew us away. And so it was a very easy business decision to say, well, everyone says they want to stabilize at a yield on cost and then sell it to an institutional investor. That's not the business plan that worked out for us. I don't think an institutional investor would have come close to offering what the user offered us, and without having to go through the leasing costs. So for us, it's, we're nimble enough to figure out where is the right outcome to go full cycle on a deal, but we're certainly not in any pressure to do so.
Yeah, creative, I think, is a good word for that. And, being open-minded to different exit scenarios. Obviously, we go in with the plan. We think, okay, yeah, that's what's going to work out. And then things evolve. Things can accelerate, things can take longer, but adaptability, I think, is and nimbleness for your shop is something that could be highlighted. And we started this discussion talking about what makes Snowball tick, what I think is the advantage. And you mentioned your knowledge of New York and everything that you've built up on your career to come to the point of investing in tri-state and New York area industrial real estate. And I think that knowledge premium that you guys have probably has been what's paid off over several years. But the market and technology is changing too, right? I saw that you had posted something on your LinkedIn about regression analyses, backwards looking historical data. And wanting to use more up-to-date data in your analyses. How do you feel about, new analytics platforms, Gen AI, any other technologies that might enhance, or do you think that they're just distractions for certain aspects of real estate?
So when I was at CBRE back, and I started in 2003, CBRE acquired a company called Tordo Wheaton Real Estate Research in 2005, 2006. And Ray Tordo is a legend in the business. And they had a macroeconomic tool. And I would review the macroeconomic analysis forecast for Montreal year over year, and it would be dead wrong. I don't think much has changed, honestly, because it is backward looking. It is using regression analysis tools, and you can run fancier computers at fancy speeds, but at the end of the day, it's not predicting COVID.
Right.
It's not predicting onshoring. It's not predicting a geopolitical recession that we have not seen in 70 years. So good luck to them.
Yeah, it's interesting, right? I think that Gen AI and technology are interesting. They can do a lot on a lot of tasks, right? You can program Python code for much faster and cheaper. You can comb through data and synthesize and analyze information, especially documents, a lot faster. But I think the combination of human intuition and human knowledge and application, along with the amped up speed of doing that, right? You still use a spreadsheet, which is technology, but you're not trusting just an Excel model to make the decision for you. And I think the same way could be said for Gen AI or any other technology that comes to light, which is it enhances you. It's a tool to make work easier and faster and more accurate, but it's not a replacement for decision making. Would that be an accurate assessment?
Very much so, because it misses out on motivations. An industrial owner who bought a property 20 years ago and has a $20 basis is going to have a very different leasing mindset than the owner who bought in 3 years ago at $100 a foot.
Yeah, I think you're highlighting one of the biggest things in real estate that I've seen is the information asymmetry, right? There's private markets and then there's commercial real estate, which is an incredibly opaque when it comes to information market. Until you dig into the financials of a specific property or a specific area, know the history of that buyer, know the history of the tenants, you really don't have a picture. You can ballpark it with market cap rates, but you can ballpark it with different macro features. But even the analyses that I've run personally, I think most of the factors only account for 30-40% of the variation between returns for a lot of CRE, which is a far cry from public market stocks, which is the single factor can account for 70 to 80% of the variation of returns. Not to get too technical for our listeners, but I think that highlights the major information gap that you get and the major person gap that you get when you do commercial real estate.
It's still such a human part. And again, I was a broker for almost 15 years, and personal relationships, the ability to distill the asymmetrical information that was coming in, to understand, again, motivation of the individual actors. We used to value properties and we would come up with 4 different valuations. This is what the private guy would pay. This was what a REIT would pay. This is what a pension fund would pay. And this is what a foreign, investor would pay. And we would tell the client, we're not sure who's going to show up. We'll run the process. But if, we're able to get the foreign, they might have the greatest ability to pay for the shiny object. And so you just don't really know who's going to be there at a point in time to be your tenant, to be your capital partner, to be your lender. And it would be wonderful if we could predict these things in a way that, makes us all happy. But again, I think all you're doing is ballparking. And frankly, I work in much higher degrees of perfection of analysis than ballparking. And so we have to be nimble. We have to be analytical. But we're paid to achieve premium returns. And we're paid well if we're able to do it, because it's a very risky business that we embark upon. But we have to really understand every leasing deal, every investment transaction. We have to bid on every investment transaction to get the inside knowledge of why that transaction happened the way it did. I'll give you an example. We bid on something recently in East Haven. And we weren't the most aggressive bid, but we loved the deal. And ultimately, the whole process was set up to get the tenant to pay the most. Right?
Yep.
That was it. They had an idea of what they wanted to do. They ran the process. They gave the tenant the right of first refusal. And through that process, the tenant had to pay 30% more than what they would have paid to begin with.
Pretty simple.
Pretty simple. There's a story to every deal, which is also why a lot of investors, the first thing they ask us is the origin story of how we got the deal. And we're happy to explain it because every deal does have a story. And it's relevant to the individual investor, whether this was off market, fully marketed, broken process, stale process, direct consultation, how long have you had the deal under contract for? All those things matter because sometimes time kills deals, but also time can cure deals.
Yeah. I think that one of the things is that you're really, again, driving home I talk to every person in real estate that's successful, I'll say, really drives home the same point, which is it's such a human business. It's a person-to-person business. It's a relationship-driven business. And if you unpack, when I was working at UBS, I had a lot of time to analyze mutual funds, investment managers, all sorts of investments. And what you really realize is that a lot of the data is, second to what you're really trying to get at. You don't need to see the returns of mutual funds to understand. What you want to know is the story. Why are you acquiring these things? And the same thing with real estate. Why are you acquiring this? How did you get it? What's the story behind this? And what's the relationship that I can build with this community, with these people, with my investors, and everything that goes into all the stakeholders that go into this real estate endeavor?
Everyone has their own version of a chessboard that they're playing. And sometimes it overlaps. The brokers have their own view of what they're trying to achieve, which is market share, influence, possibly getting into higher value transactions or doing a higher volume of transactions. Pension funds, institutions are looking for higher quality, more resilient income. That's why they're all vacating office right now, because office is an uninvestable asset class for an investor who is looking for reliable income.
Wonderful.
Right? People love getting into a value-add industrial until they realize how mucky it can be at times. Credit of tenancy is not always there. Environmental challenges, survey issues, it is much rawer and it involves more risk and it requires a much more hands-on operator than, groups who, don't want to pay a manager because they hate the idea of paying fees. So everyone's got their different chessboard. Family offices have their own view. People play in different submarkets where there's lower taxes because that's more important to them, even if the growth isn't there. Or if it's riskier because of the volatility of the supply and demand metrics. So everyone's got their own thing that they're trying to solve for. I know what we're trying to solve for. We're trying to build a company incrementally, getting better at our own processes, getting better at developing relationships, seeing more of the leasing market than we see today, and hopefully being rewarded for putting in the time and the effort to getting the market analysis really right.
A very clear motivation for you, and I think it pays off in the long run. Well, Brian, really appreciate you hopping on the podcast with us. Fascinating discussion as always. I'd love to hear your perspectives on the market because it is so differentiated. And thanks for joining me today,
Daniel. Thank you so much. Great questions as always, and really appreciate everything that Equity Multiple is doing to educate the market into how to invest in commercial real estate.
Thank you so much.
All right, that does it for this episode of Multiple Perspectives. Thanks to Daniel for bringing this awesome conversation to us. And thanks to Brian for taking the time to give us this window into his world. For more on the industrial asset class and investing in these types of offerings, we've got a ton of info in the Learning Center on our website. You can find that at equitymultiple.com/blog or by navigating to the blog on the top of the homepage. In fact, we'll put a link in the show notes just to make it easy. Thanks for joining me once again here on Multiple Perspectives. I'm David Lofgren. And as always, you can let me know what you think of the show via our email, multipleperspectives@equitymultiple.com. Say that 5 times fast. See you on the next one.